Several years ago, I was in a position where I was running business development for a top 10 software publisher in the world, and we had identified a category of product that we were most interested in having in our portfolio. And we went through the stages of making a business case as to whether or not we wanted to build this product or go ahead and buy it. And so the make or buy decision is oftentimes a crossroads for any large technology company. And in our case, we figured that we could go out and buy this particular product and get to market that much quicker. So the stages were fairly simple. We had a team in-house that would filter many of the opportunities that would come across to us directly, and at the same time we were out searching various sources for development teams and other smaller companies that were in this business. And as one thing led to another, we ended up finding a small development team that had been established right from the start with the idea of building this product for an asset sale. And so this fit our criteria quite nicely. And ultimately what happened was the fact that we went through an initial, I think we took these folks out to dinner, and we ended up doing a bit of a trial balloon on a price tag that we were willing to pay, which happened to be about $3 million for the source code. And at this point in time, this small development team decided that they probably were better off if they brought in a professional consultant to advise them on the process of negotiation. And that individual and I and our lawyer at our company ended up fielding their counteroffer, which was in the neighborhood of $11 to $13 million for, again, the sale of the asset. And this was interesting to us because now we felt we had a sort of high and a low set of parameters on the deal price, and now it was important to further define the specifications of the product and ultimately see if we could negotiate these folks down a bit. We went through a couple of weeks of due diligence on the code, looking at it quite intently, and at which point, once we had fleshed out the exact specifications and code requirements and had built a business case for our own internal executive staff to ponder, we countered with a number somewhere in the neighborhood of $7.5 million, which subsequently came down another $1 million once we axed out some of the code and product features that we decided not to buy in that first rev of the software. So the lessons learned here, or the lesson to the entrepreneur, is one, once you have decided the fate of your development effort, whether it's to build a company around a product or to go ahead and build the product for an asset sale from the get-go, it's important to identify the prospects who would comprise a short list for you to sell this set of assets to. And again, knowing that the buyer most likely will be in a competitive scenario, knowing that you've got that advantage in the sense that you can identify which other competitors to that company may be prospects, or indeed they may be already in market with a product that competes with this larger company. So you have to sort of play out those elements, as well as understand that the buyer almost will never pay what your asking price is, and ultimately you're going to have to find a middle ground that makes sense for both parties. One of the important criteria in evaluating the decision to make or buy is time to market. And many times companies will go through a pretty in-depth analysis on what their cost to build that product is based on their methodologies, their quality assurance requirements, their testing, their distribution, their packaging, whatever it happens to be. These sets of analyses oftentimes help define the value of the particular product assets that they may end up buying. So the valuation process typically is one that has quite a bit of analytical investigation and analysis, and ultimately projections and cost of goods, and the essence of this is to construct a monetary value on what it would cost to make that product in-house. Subsequently, that can play into the structure of what they would be willing to pay based on the fact that they could accelerate their time to market and get in market quicker, thereby generating revenues faster and ultimately seeing a faster rate of return on that investment. So these are things to consider as you're going through the valuation process, knowing what it took you to build your product from a pure time, cost plus time analysis. When buyers are considering the make or buy decision, oftentimes they do a calculation that incorporates increases to the pure development cycle in the form of burdened costs. And burdened costs can sometimes be as much as 30% on top of the man months or man years of engineering time and quality assurance and testing time, as well as other factors and variables that come into the mix. Ultimately, a time to market multiple has to be assessed as well, and this may be to the advantage of the seller because in essence part of your argument is to the buyer that they can get in market faster, generate revenues quicker, and ultimately get a faster rate of return. So these multiples vary. As we were going through the analysis in-house on what we should pay for this particular product, what was interesting is our sales team and our business development teams came together and ultimately came up with a projection of $15 million. We ended up paying $6.5 million for this product, and in the first year generated upwards of $22 million in revenues. So obviously the return on that investment was significant, way above 50% above our projections, and in essence it goes to show that a lot of times the buyers are definitely on the right track when they want to make their buy decisions, and therefore you as an entrepreneur who has built your company with the notion of selling the assets now you need to do your homework on identifying all the prospects and pursuing them with a vengeance so that you have more than one buyer. It's always best to have at least two in the negotiation, which in our case was exactly the scenario. We knew our competitors were looking very closely as well until I'm not sure we actually signed a no-shop clause in the term sheet. We actually did, as I recall. And so the no-shop clause prevented them from going to the competitor after a certain amount of time. Of course, I think that was a 6-week no-shop clause. One of the important aspects when you're approaching the cycle of selling your technology and your assets is to get more than one buyer. And the way to do this, of course, is to do your due diligence and homework on all of the prospects that are out there, be proactive in approaching them, and ultimately, hopefully, you can get two companies that are sort of in a demand bidding war to ultimately buy it, and at that point in time you'll most likely have to sign a no-shop clause in the term sheet so that you can concentrate on the negotiation with one of those companies, but all the while this is the scenario that makes the most sense for you because you can use that as leverage in your negotiation. In our case, we knew there was another buyer in the hunt, and so we signed a no-shop term sheet, a no-shop clause in the term sheet with our sellers, and this enabled us to concentrate on getting the deal done. And the sellers, of course, had the advantage of knowing that there was another party potentially on the sidelines ready to jump in if our deal didn't happen. So it kind of works both ways. It's pressure on the buyer to cut a deal, and it's also pressure on the seller to cut a deal as well, because you never know if that sideline player may find an alternative. In our negotiation process, the first volley was served by our side, where we pitched a $3 million price tag, and this sort of I think sent some shock waves through the minds of the sellers, and they ultimately went out and found a professional negotiator consultant who had much more experience than they did in the negotiation process. This individual and I spent a number of weeks together hashing out the details of the requirements of the code, as well as kind of where we felt we had to have the parameters of the deal. And at that point in time, they countered with an $11 to $13 million range, and we ended up settling somewhere in the $6.5 million range. We had in-house counsel, and they brought in third-party attorney support so that they could as well handle this in a professional manner. So it's advisable, if you haven't been through the cycle before as an entrepreneur, to explore the retention of a professional negotiator, simply because you can ultimately preserve some of the value of your assets as you go through the price negotiation. I want to talk a little bit about the approval process. Once we identified the requirements and understood kind of what we were looking for in the market, and found kind of a very attractive set of assets, we ended up spending literally weeks, our team, on constructing all the due diligence documents, market requirements, product requirements, projections, a lot of spreadsheeting out of anticipation, and of course we had many different sales channels, and so we incorporated and elicited feedback from our sales team to really get an imprint on what we could do with this product once packaged and sold through our multiple channels and in international markets. So that process alone took probably 4 weeks, and then once we had a term sheet identified, then I think that process was another 6 to 8 weeks of definitive agreement stage, where a lot of lawyering took place, a lot of details surrounding the language in many of the sections of the documents were refined, and ultimately the whole deal from start to finish was about a 3 to 4 month cycle, which I think is probably about standard. Obviously you can do it quicker, and certainly it can take longer as well. So I hope that helps. So the way we worked is for ultimate approval, we presented our case to the executive management team of the company, and the CFO of the company took it to the parent for final blessing through the CFO of the parent company. but they had already earmarked an amount of capital for these kinds of investments and these kinds of acquisitions. So that was not really a very long process, but clearly, there's going to be a cycle of approvals that most likely will take longer than you expect and that you would want, but that's just the reality of how big business works. And obviously the nimble entrepreneur with your scaled down team can move very quickly, but the opposite is true when you start dealing with bigger companies. What was interesting about the way the sellers built their company and their asset was right from the start the notion was to build this to sell. And so they kept their overhead extremely lean. They used outside contractors for testing and QA. And they really had very little overhead to support. So as they went through this cycle, the ultimate deal price proved to be a very high return on their time investment in building this product. Obviously, they had the foresight to realize it was going to be a hot product in a hot category, so they had the right development tools to build this out efficiently, effectively, and in a very expedient fashion. And ultimately, I think from the standpoint of the seller's perspective, sometimes it does make the most sense to go this route, which is building the product right from the get-go for an asset sale, as opposed to trying to build an infrastructure and a company around it with layers of support personnel and staff, which require obviously a lot more venture money or private money to set up that infrastructure. The way this deal was structured was clearly an asset sale where we paid cash for the assets as opposed to stock or other instruments or currencies, and it was done in a very expedient fashion because we knew time to market was critical.